KRVN.
Good afternoon and welcome to the Channel Final Bell on the Rural Radio Network. I'm Alex Makovica. Joining us to break down today's trade, Mike Zuzolo with Global Commodity Analytics. A quick look at the futures here, Mike. Corn, soybeans, and wheat settling higher, with wheat the leader to the upside, up about 8 cents or so, and livestock futures sharply higher, up over $5.20 in the August feeders. We'll dive into more of these factors, but as you looked at today's trade, tell me what stuck out to you.
Well, I'd say, Alex, I'd call this price action on Thursday as we wrapped up the grain trade a little bit more disappointing, given such positive comments by President Trump on the U.S.-China tariff trade news. And I'm not ready to put it in the can yet by any stretch of the imagination, but I do think that we need a better Friday as far as a weekly close, because wheat and corn barely closed higher on the Thursday grain trade. July corn earlier in the session hit a new monthly low and got us within, I think, a quarter penny of the May low as well. So we really took some of the technicals out of the lead month corn, which was very surprising given crop conditions that we saw this week. I'd also say the soybeans probably were pulled down a little bit more than I would have liked to have seen, especially given that both the product markets, the bean oil and the bean meal, both lost quite a bit as we closed out the session, closing negative on the day. Not by much, but just enough to make it look red on the screen. And I think that goes back to the meal export sales being down about 14% from the 4-week average, and the bean oil export sales being down 33% from the 4-week average. We looked like earlier this week we were putting a low in the meal, and it looked like we might be trying to stimulate a buy signal by getting up around that $300 ton level. But we weren't able to follow through on Thursday. Something else I'd like to see happen on Friday.
Okay, let's dive into this trade situation we're in right now. You had mentioned, we talked a couple of times here on the airwaves, a phone call made, and it sounds like negotiations could move forward. Since that time, have there been any new developments, and what specifically is the trade watching for, Mike?
I think the trade is now at a point, especially with the new spending bill having passed the House, but looking like, cosmetically at least, it's being hung up in the Senate and getting bogged down in Washington, because these are two key pieces, probably the two biggest pieces of our global economy and the U.S. economy not running into a recession. And I think this is especially important for those consumption-sensitive commodities like beef and like vegetable oil. But I think that the trade really wants something to be done concrete at this point, Alex, because we are, after all, in June. We just saw a brand new leader get elected, an opposition leader get elected in South Korea. It's going to take some time for us to get a deal with them, I suspect. Japan is hung up like China on the new increase on the steel tariffs, going from 25 to 50%. Even the European Union was squawking about that after we made that announcement. And so what we really need is a shift in momentum, I think, in terms of some concrete movement and good, solid action in terms of a trade deal being struck. I have gone on record, and I continue to believe that it's a lot more likely, in my opinion, that we'll see a trade deal with India before we see a trade deal with China. And I just feel that way for two reasons. I just don't think the U.S. and China are the same countries they were during President Trump's first term and the Phase 1 trade deal. I think there's too much water that's gone under the bridge at this point. And I also feel as though we've got a marketplace now where China feels like they don't need the United States as much. And so I think it puts a lot more pressure on us than it did maybe 4 years ago. So these things, along with the geopolitical issues that, with Russia and China being so closely tied together at this stage versus, 7, 8 years ago, it seems to me that it's going to be difficult to get a deal with the U.S. and China soon rather than late.
Okay, let's look at India then. What are the opportunities for American ag with that country?
Yeah, number one would be the biofuel, the ethanol demand that India could be looking at, and the vegetable oil demand in terms of a green diesel. I think those are the two things that stick out at me the most. I would also probably include wheat. I would probably include dairy, and I would probably include some meat in that as well. So I think India, I have been told many times, and it started a long, long time ago by others in Chicago and other people in commodities, that India could be the next China in terms of a brand new commodity demand super cycle coming in and elevating the demand in a long-term big picture, just like China did back in 2000, 2001 when we helped them get into the WTO. So I think India could be a game changer, and I think especially given the fact that India is right there in Asia with Vietnam, with Malaysia, with Indonesia, with Japan, South Korea, and Australia. If we could get a trade deal with India, I think that would put the Chinese policymakers a lot more on the defensive and want to make a deal with the U.S. And I think it would also make the other countries that are looking at doing a deal with China before the U.S. second guess themselves and maybe change their mind. So if I were in the White House and advising the president, I'd be saying, let's get to India before we do anything with China.
I just did a real quick Google search, Mike, and it looks like India's population versus China, very comparable. Call it around the 1.4 billion mark. So that could certainly be a good opportunity.
Yeah, that's an excellent point. And they're a young population, whereas China, like the United States, is aging. And the senior citizen social layouts expenditure that both the U.S. and China are going to have to put out in the next 20, 30 years, India is almost the exact opposite. So really different look in terms of a potentially new burgeoning young middle class.
Okay, Mike, stick around. We will be back for the second half of the Channel Final Bell, brought to you by Channel Seed and your local Channel Seed Pro on the Rural Radio Network right after this.
The list goes on. But with the enhanced Channel Seed brand's top-performing products, innovative digital tools, and expanded agronomic support, you can rise to meet them all. Channel Seed, let's rise to the challenge. And catch our new Channel Nebraska podcast on Apple, Spotify, or wherever you get your podcasts. Read and follow pesticide label directions, IRM, grain marketing, and other stewardship practices.
TN.
Welcome back to the Channel Final Bell on the Rural Radio Network. I'm Alex Makovica. Mike Zuzolo with Global Commodity Analytics joins us to break down today's trade. We spent the first half talking about some trade opportunities with India and what that could look like. You touched a little bit on crop conditions here in the U.S., which has certainly been something we're keeping an eye on. Tell us more about what you're seeing across the country, what concerns you're hearing from producers.
Yeah, this came, I think, as a result of the crop conditions came up as a point of contention for us, Alex, not just because of Nebraska showing up at 68% good to excellent in corn, and that being the second lowest in 5 years, second only to 2023 in good to excellent conditions. But it also, I think, is coming from the fact that we've got a July D's corn spread that has now struck a new 10-month low as of Thursday's close. We have essentially gone from 30 to 35 cents premium in the July, in April and May, to now 9 to 10 cents discount the July here after the close on Thursday. So we've lost about 45 cents in that spread with a very tight old crop carryover and conditions on the eastern corn belt and central corn belt even worse than what we're dealing with in the western corn belt. And in South Dakota is another one. For instance, Ohio, their crop conditions are at 46% good to excellent, the lowest in 5 years. Clients there are having problems getting planted. I've talked to two clients in Illinois, in the southern third of Illinois, essentially east of St. Louis, directly east of St. Louis. They too have had a lot of problems getting planted and are doing a lot of replant of corn right now. And Illinois as a state, it kind of slipped past me after Monday's numbers came out, but at 63% good to excellent. That state also is the lowest in 5 years, and that joins South Dakota, which is also the lowest in 5 years. So I think there's a question mark in my mind why we would be slipping so badly in the July corn and not keeping the July elevated to pull in more corn from producers on a tight new crop supply. So that's something I think, again, on Friday, I'd like to see a reversal, and if not on Friday, by the end of next week, and after we get past the next WASDE report, see that July come back in and take over in the driver's seat.
With the potential for replant, is there a possibility that it shifts this corn versus soybean acre thing we've really been focused on this year?
Yeah, it does. And I think it also really maybe opens up the door with farmers very stretched right now economically and financially as to whether we really get the harvested acres that the USDA is expecting at this point. And I'm not sure that they would mess with planted acres, but I feel like that 181 national yield is just not there yet as far as the corn crop goes. And if it is, we're going to have a lower harvested acreage number. So certainly one of the things on my list is whether we do see some corn move into bean acres, especially given we've seen this rally here in the soybeans, or whether we just see corn being taken as prevent plant. And we do have a very wet weather model map here going into the next 10 days. So I think that'll be a concern.
Okay. Mike, let's shift our focus here to livestock complexes today on the futures. Live and feeder cattle surging higher over 520 in the August for the feeders. A weaker day on the futures for lean hogs. But tell us more about this livestock picture as a whole and what things you're really taking away from that.
Yeah, to take a bigger picture look at it, Alex, I have talked about the past 3 weeks with clients and subscribers about my two main goals coming into the early June time period. If we could get rallies, was to hedge beans and to hedge cattle and feeders. And so I did the bean hedges about a week ago when we were rallying, and we're back up to about where I got in and recommended getting in. Doing only bought puts, though, just trying to get a floor underneath me in case we have a similar price action as 2018 when we literally lost about $1.50 a bushel in beans. I feel the same way about the cattle market because I think a big push in this cattle market, probably I would guess 75% of the push to the upside is really based upon the screwworm and the border being shut, and that the cash prices continue to just move sharply higher. I don't have the risk-reward mindset to go after short futures or unlimited risk positions, though, because the money's just not there as far as break even. It's kind of like soybeans. I saw that Pratt, Kansas ran a 878-pound steer through at $305. I put that in as a break-even using a 3.5 rate of gain. I put the break-even on that at 237 for fat cattle at 1,300 pounds. And if you take it up to 1,400 pounds, you still need 226 to get a break-even. Those numbers just aren't there. You know, your back-end February fat price is running 211 right now. So I think a price drop led by the funds getting out, led by fresh news, if the border would open up or if Wall Street would start to go down again, I think it's good risk reward to have something underneath you on paper and known cost. So I'm going to be making recommendations tonight via my text blast to go ahead and get recommendations of 50% hedged for Q2 and Q3 here at this point with this record-breaking pace that we set once again on Thursday with another brand new record of 223 in the fats and 309.47 in the feeders.
That's all the time we have. Mike Zuzolo with Global Commodity Analytics for the Channel Final Bell, brought to you by Channel Seed and your local Channel Seed Pro on the Rural Radio Network.